I'm going to show you a simple strategy where you can invest $500 a week, win just an hour a week, one trade a week, no day trading, safe, consistent growth. And by the way, thanks for all of the great comments and feedback that I've been getting on the other videos. This is a variation of that strategy with more depth, more detail, and I'm going to show you this strategy in 4 simple steps. It's not going to be complicated. Anybody can understand it. So let's dive in. Oh, and before we get started, this is for educational purposes only. Financial disclaimer, we always do that. And never invest more than what you can afford to lose. Remember, it's all about the money management, and I'm going to be hammering that home in today's training. Okay, so let's just jump right in with the strategy here. So step number 1, we're going to show you, this is what you're going to learn today, how to avoid disaster. That's the most important thing because you got to learn how to survive. Number 2, how to trade high probability. Again, we want to win and we want to win all the time. Anything can happen in the markets. You got to be prepared for it. Also, we look to create 1% a week with just an hour a week. So step number 3, how do we keep it consistent? And then number 4, how do we do it in just 1 hour? By the end of this video, you're going to know everything that you need to know. All right, so step 1. Avoid disaster and create wealth. Balance your risk before you chase reward. I will tell you that I was horrible at this. I would always have visions of great success, always believe that I was going to make $1 million. And because of that, it caused me to make big mistakes. And those big mistakes caused a lot of pain. So don't go through the pain that I went through. And if you're in pain right now, recharge. You know what? Cut your losses, learn from the beginning, and just focus on managing your risk. It can be so painful, but I don't want you to go through that. So the first thing is, in this strategy, we're going to be focusing on an account of around 10,000. You can start with whatever you want and whatever you want to make a variation of. But for this example, we're going to do a $10,000 account. And so right over here, you might notice that I say deploy 25 to 50% at a time. That's a very important theme throughout this video and throughout this strategy. Remember that. And you might not understand why, but I'm going to be explaining why in great detail. And by the way, also ask any questions you might have, right? And so what does that mean? Max 5,000 being used? Well, that means if we're going to do 50%, it's 5K. And so what I'm recommending is that we use either 2,500 to 500 being deployed and never going above that at all times. And that's very important. You're going to learn why. Stay connected. All right. Stay engaged with the content. So the first thing is, money management wise, how do we avoid disaster? Well, it's all based off of the VIX, right? The VIX, the volatility index, right? That's the VIX, the volatility index. What does it mean? It means how crazy the market is, how fearful it is. Look, a low VIX is the calm zone, and a fearful VIX is above 40, the fear zone, right? The fear zone. Now, with that being said, I think that's a great way to understand the VIX. Usually, when the VIX is up, we see the market down. And here's the crazy part. See how it says 25% and 50%? And this is a big part of this strategy. So you might not get this in a lot of places, but right here, when its markets are calm, we only want to risk 25%. When the markets are high and fearful, we want to invest more. And I'm going to go into detail as to why we're going to do that. But for now, you just want to be understanding the main concept here. And that is, when the markets are calm, we want to go with 25%. When they're fearful, we want to go 50. You might not understand it right now, but just hang in there. I'm going to get to it. So here we go here again. Calm, deploying 50% or 25%. As the markets get more fearful, more volatile, we increase our risk. we increase our trade size. So just, do you understand that? It's very simple. It doesn't make a lot of sense to a lot of people, but let's keep going. All right, so now how do we do this? Well, so number one, this is me at 24. I grew my account at 30,000, which is equivalent to $90,000 in today's money. And I made a big, huge growth early on, but guess what? I made a lot of mistakes along the way. And my greed and my fear and all of those emotional things caused me to make a lot of mistakes, and it caused a lot of pain for me. And so I share what I want to share so that you don't have to go through the same mistakes that I went through. And by the way, this is another big lesson here. That's worth that was in the year 2000. And it's probably worth 90,000 today's money because of inflation. The reason why we do what we do is because we're trying to fight against inflation, because our wages don't keep up with it. Our jobs don't keep up with it. How do I know that this is the case? Well, it's pretty simple. I grew up and my first apartment was in Salem, Oregon, okay, in 2000. Salem, Oregon in 2000. And I paid $350 in rent. And that was a cheap apartment, but it was a 1-bedroom. It wasn't like, it might have even been a 2-bedroom. I can't even remember. I think it might have been 2-bedroom because I might have had an extra bedroom. But either way, it doesn't matter. 1 or 2-bedroom, and it was $350. I know for a fact it was $350. However, nowadays, go ahead and look at a 1 or 2-bedroom in Salem, Oregon, and tell me what those are worth, right? Low dollar. I haven't done it, but I'm going to guess $1,200, right? So that is a huge. That's 4 times. That's 4 times. So you take this 30,000, you times that by 4. That means the actual value is probably 120,000. Okay. Now, does your wages keep up with that? No. Investing can. And we want to also remember here. So my big lesson, I'm going to get to the strategy, but I just want you guys to get this because I don't want you to make the same mistakes. You can have big dreams like I had, but you got to have a process, and I'm going to share some more about that here. You know what? Process equals profit, right? Process equals profit. It's not so much, look, if we have a process, we can have the profit, but don't focus on the profit first. Manage risk first, profit second, and keep your emotions out of trading. I have made some big mistakes, and I've learned that slow and steady wins is what will win over time. Okay, so that's step number 1, just managing our risk, right? And using the VIX to do it. You're going to learn even more as we go. So step number 2, I'm talking about a $500 risk. That's one of the great things. This strategy I'm teaching is credit spread. And it's a variation of the one in the previous video that I got thousands of comments on. I'm so thankful. I replied to every single one of them, and I'm going to keep replying. So keep asking questions until I get buried in comments. I think this video is going to really do well too. So anyways, $500 is the risk. Now, the credit is 125 and the ROI is 25%. The cool thing about credit spreads is that your risk is defined. You know what you're going to lose. And when I say risk, that's actually wrong. It's the cost. You have to have 500 in your account, but you're actually risking only about 375, and I'll get into that as well. So the risk is actually less, which incredibly improves our performance. So that's a really cool thing too. Okay, so here is how to execute this trade. I'm going to go through all of the details. This is the meat of the strategy. This is what you're all being waiting for, but don't click off because I've got other bonuses stuff at the end. Now, first of all, this is on the XSP. I didn't put it in the chart here and I forgot, but this is the XSP. This can be done on the XSP or the SPY. I use SSP because you cannot be assigned, right? You cannot be assigned on the XSP. But other than that, it's really the same. All right, so first of all, step number 1 is I'm going to be looking at the POP and the delta. POP and delta. Where's that at on the option chain? POP, probability of the money. I'm always going for a minimum of 30 and 67%. Why is that so important? Well, because I'm looking for probability first. I want to know that I can win a lot of trades. If you look at this, it's 672 over here. That's the underlying price. That's what you're seeing on the option chain. Here, over here is the expiration. Okay, this is the expiration date. I'm going out for 45 days. That's what I always like to do. And there's a reason for it because it gives us time to recover. Okay, the next thing I'm looking at, this is the strike price right here. And the way that I execute the trade to do a credit spread is you sell the 655 and then you buy the 654. And so you collect the credit in between. You'll see it in the next screen. I'm going to show you how that works. But I'll shop around for better credits. Sometimes I'll get higher probability. If I can't get the minimum is a 25% ROI. If I can't get that, I'll go out to a further expiration date. Instead of going here for 48 days, I'll go out even further for 60 or farther to increase my ROI. I want to take a minimum of 25% with also the minimum of this on the probability scale. Okay. Now, another thing that's really important here is that my risk is my stop. And so I'm looking at only trading 5 to 10% of my trade. Okay, so we want to risk 5 to 10%, 1 to 2% per trade. I will bump this up, and for simplicity, I will break this out into 5 trades, or I will just do 1 trade. And so for this one, I'm actually not following this. I'm going to be doing the 5 to 10 because I'm trying to do it in less than an hour a week, and the less that I do, the better. And so if I'm doing high probability, this will work pretty good. All right, also remember the risk is my stop. I personally use a stop loss of the trade. So in this case, I'm going to risk $500. And that is going to be my stop loss. And actually the max loss is 375 because I'm earning a credit of 125, right? So if you take 500 and you get 125, then your actual risk is 375. So my max risk is 375 and I'm willing to lose the entire thing. And that is my risk. I don't very rarely will I hit that. Because why? Because I close the trade. This is another little note here. Take notes on this. I close it at 21 days remaining. And the reason I do it is because I want to eliminate my risk probability so that I'm not risking the full amount. If it's down against me, I'll just close it. The other reason I do it is so that I can reinvest that money and put it to use at something else. If the trade isn't working, go ahead and reinvest and get more credit, right? Keep that thing rolling. And then the other thing, let me go to the next page here. So let me show you what I do here. So here it is, 125. This is the trade. And you can see that it's 375 max loss. And the total here is 500. That's what you need, the buying power you need. And I personally use Schwab, even though there's a commission, whereas Robinhood doesn't. I use Schwab because Schwab has really good customer support. So that's what I like. I like the fact that I can talk to people if I need to. Okay, very important. They've helped me out a ton of times. And so when I receive this credit, this is the credit I get, 125. When I get it, actually it's 118.40, I immediately put a target at 0.5%. I will put a closing order. And so how do you do that? You just go in and you say close order, and you then put it for a 0.5%, 50% profit target. So when the trade gets to 70, whatever 125 divided by 2 is, I'm taking the profit. Right? Why do I do that? Again, so that I can keep that credit low. Sometimes it'll hit in 2 days and I want to keep that credit rolling. If I can get this in 2 days instead of 48 days, I could get 70 some dollars, and I could do that every 2 days. It's going to increase my profit and get the snowball rolling. It's really important that we do that. All right. Now, again, this is the third part, and this is the part about the consistency. And this is a really important part. Now that we know how to take the trade, It's about how to manage the money and how our time works, right? And so I do one trade per week, and I'm doing it on Monday. One trade per week, and I'm doing it on a Monday. And I'm doing what? XSP. Okay, it's defined risk, and we're doing 5%, and its simplicity will compound the results. So let's take a look at our rotation. Week number 1, we're risking 500 or 1,000 based on what? Remember in the early stage of the video, it's based on the VIX. Same week 2, 3, 4, 5. And so what is that? 2,500. Right now, it could be 5K or somewhere in the middle. It depends on what? The VIX. The VIX, which is the fear. The more fear, the more money we're going to put in. And you're going to still hang in there with me. You're going to learn why this is so important. Okay, but this is important. This is our cadence. This is the cadence I use. This only takes me an hour a week, right? It's my cadence. Now, always have liquidity. It's really important. After 5 weeks, you're going to have 2,500 to 5,000, anywhere between 25 to 50%, and you never go above. Very important that we do that. Why is it important? There's 2 reasons why this is important. Number 1 is we never get stuck. We want to keep the gears of machinery rolling. We want to keep the capital machine rolling. And so it's important so that the income is always coming in and we can always add another trade. If you're maxed out and you're stuck, you're in trouble. And I'm going to go over to that here. So this is actually an equity chart. And again, this is a disclaimer. This is risk disclaimer or whatever. This is educational purposes only. But this is an example of what the S&P chart looks like, right? And this is we're just going to use this as a demonstration, but this is the 25%. You're making 125, 125, 125, 125. You're just slow grow. You're hitting your trades, great win rate. And this is on the first 90 trades. Okay, well then all of a sudden, the market goes crazy. And what happens? The VIX starts going up. The market gets dropping and it gets fearful. Now, this is where all of what I taught through the whole video now comes together. Now, if you are at 100% of your trades, you got everything traded, what happens here? It's a total collapse and you lose your account. And this is why traders get into trouble, is because they don't have any capital left to recover. So this is critical. Right, but now what we're going to do here, you might lose all of these trades, but if you're only losing 25%, that's okay, because you've already been making money and your account's growing. You might have gained it by 25 or 50%. And then we get the dip here. Well, now we have money because we have money. So now we're investing more and more and more and more. And our trade size, we're at 50%. Is bigger. And so when we make money now, we're doubling our size and we're coming back. Okay, that's why this is so important. And the other factor that makes it nice is when the VIX is high, you're getting higher credit. So not only are we, and this is worth the price of admission here, not only are we getting bigger trades because we're doubling our size, but we're also getting more credit. So we're making comebacks even faster. And then we come back and now we're back to 25% of our account again up here, right? And so that's why the money management, that's why I taught all that I teach, and it's so good. So just in recovery here, or in recap, it's a 45 to 21 day timeline, right? Early profit, less risk, consistent wins, gets predictable returns, and faster reinvestment. So I'm doing 5% per trade, 25% total exposure, or up to 50% when the VIX is about at 40. And we do this, we're placing the trades every Monday. We're doing 45 days out. We're closing at 21. We repeating the process. And that's step 4. 1 hour a week, we go in. It actually only takes 10 minutes. The only reason it's a little bit more is because you're managing your trades throughout the week. If one closes early, you're going to instantly get back in. All right, so you just want to monitor for that. Pretty simple stuff. And so again, here's the very simple XSP or SPY, repeat it weekly. You focus on probability, and that's it. So here's really important, strong trends. This is the S&P 500, great winning streak. And out this since 20, we've done really well. There was a little bit of a challenge here in 22. This still was working in that time. If you look at a back test, I recommend go ahead, do a back test, do the work, be an extraordinary trader with extraordinary profits by doing what no one else will do, and that is go back and do your homework, right? Go out and then come back and comment on this and say, I did the back test, it's amazing, or I did the back test and it sucks. You know, just be extraordinary. I'm calling to the extraordinary people on this channel. We're looking for the greatest, okay? And I want a community that's going to do that and help others. Here's another example here, Robinhood, where it works really well. And then here is the 4 steps that we need to do. Number 1, avoid disaster, discipline. Number 2, high probability. 3, 1%, the weekly cadence. And then number 4, we're doing it in an hour a week, and then we're replacing income. And again, here, this is educational purposes only. It doesn't mean that you're going to do it, but this is a real life example of what we've done. We've done 100 to 2,000 in 6 months just following this process. You can see this looks pretty good. And then lastly, I want to give you guys a gift. It's a beginner's guide that I put together with credit spreads. The link is in the description. The link is also in the comments. Thanks a lot. I hope you love it. If you have any trouble getting the book, check spam or send me an email or come back here and comment. I'm not holding anything back from anybody. I'm here. I'm open. I'm transparent. I'm trying to help you. And by the way, there's another video directly above. It's a 27 winning trades in a row strategy. Check it out. And I hope you have a great day. I'm looking forward to hearing from you.